Hi, Savajit and Rohan Singh recording our weekly YouTube Charts are Fun session for the week of September 9th. Today is the after the end of the market for the week, September 13th. Wow, how quickly the market changed. Last week we ended significantly lower. We had nvidia down over 14%. Across the board we saw selling. So it started off with a very bearish looking September. Things flipped this week. We got CPI and PPI kind of tame as the market has been expecting. Inflation has been coming down, and market kind of rallied huge. In particular, if you look at the gains this week, Nvidia had lost 14% this week, recovered and gained 16, quite a rebound, 16% this week. Nasdaq was up closer to 6%, 5.96%. XLK, the technology spider sector, was up over 8%. Small caps had a decent week as well, up 4%, and so was S&P 500. So today we will look at what are the pundits. We look at what Tom Lee is saying about S&P 500. We look at what Mike Wilson, he had an interview at the Risk Reversal podcast that Guy Adami does. We look at what he was saying. And then see Carter's thoughts on S&P 500. What is he saying from his look at the charts? Mind you, Carter's kind of chart predictions were before the big recovery the market had starting Wednesday after CPI. So he was looking at more on the bearish trend at the beginning part of the that morning when S&P came as low as 5,400. But a lot changed over the last couple of days. Very bullish movement back into the market. People trying to chase stocks again. And we look at where S&P 500 and the QQQ kind of ended. And then two key things we'll be talking this week. One is China. Very few people are talking about China now. It's a contrarian play. Beginning of the year, there were many wealth managers highlighting a huge potential play in China. We look at China, the core ETF for China, the iShares ETF, and also look at a key stock there, very highly, volatile, but at the same time, strong value with respect to the cash at hand and the kind of margins and the e-commerce space, JD.com. And then we will look at gold. Gold silently has been going up steadily every month. It has come up to higher highs, and in fact this week it printed higher highs with GLD, the ETF, very close to the 239 level. We look at that, and we look at the gold miners, which have been kind of lagging, to see if you had to play gold investing in the miners, where do we think that could be headed. With that, let's just look at the charts and look at some of the analysis. So that's our Charts Are Fun blog site. It's chartsarefun.substack.com. We publish daily blogs. We appreciate you subscribing to it through your email. You'll get a notification every time the blog comes out. It's for free. And also, we'd love to hear your comments. Our YouTube site is also Charts Are Fun. It's youtube.com/@chartsarefun. Appreciate you subscribing to the channel. And also if you like the videos, if you could hit the like button, really appreciate that. So let's look at CPI release that came out on Wednesday. We're just a week from the Fed, the FOMC decision on September 18th. CPI came out at, there is the CPI including food and energy, and that came down on a steady declining trend. In fact, it's one of the lowest year-over-year increase since February of 2021. So that came in, as you can see here, the year-over-year number came in closer to 2.5%. It was actually closer to 2.9 in July. So that is a steady drop. And the core CPI came in at 3.2, which is also just about what the market was expecting. PCI, after CPI, we got PPI data the following day, which is Thursday. And it also came out tame. Month over month was expected to be 0.3. It came up at 0.3. And the year over year about core PPI came in about 2.3, which is what the market was expecting as well. So what happened was the FedWatch tool, if you look at the expectations of a 25 to a 50 basis point cut, initially after the CPI data came out, market was still quite thinking that maybe the 25 basis point made sense. It's just that inflation though is coming down. We still have core at core actually from a month over month came in slightly higher. Market was expecting a 0.2% month over month. It came in at 0.3. So that kind of market thought that perhaps you're not going to get as dovish a Fed as expected. So maybe 25 basis point would be the likely outcome on September 18th next week. Well, it turned out two of the ex-Fed presidents came out on CNBC interviews, Dudley and Mester, and both were kind of dovish, expecting that while the likely outcome is 25 basis, they didn't think a 50 was not a bad idea after all. They felt that yes, Fed is behind the curve to some extent. Yes, we've seen inflation come down a lot. The job market has begun to cool. And from their perspective, a 50 basis point would not be such a bad idea, knowing that it's all come down now to where the neutral rate is. Folks like tomlee expect the neutral rate to be closer to 3%, which means if you have closer to 3% with current rates between 5.25 to 5.5, talking about 200 to 225 basis point cuts to get it to the neutral rate. Some others, like the Wells Fargo chief economist was on CNBC, he sees it more towards the 3.5 to 4% neutral rate, given the current environment we are in which case, you're expecting maybe 6 rate cuts somewhere from over the next several months. So it's to be seen, but right now the FedWatch tool is almost like a 50-50, 55% probability of a 25 basis point cut and a 45% for 50 basis point. That's what the market is expecting. If you look at what the tomlees at the closing bell today, mentioned in his CNBC remarks, he still feels that it's not so much of the 25 or the 50, but the indications, the posturing of Powell with respect to how he sees the cuts that he's going to be embarking on. If he gives more confidence in a softer landing, he gives confidence that the cuts are going to continue in sequence, market may be just perfectly fine. And Tom's expecting the market to continue rallying, not just into the FOMC decision on Wednesday next week on September 18th, but to the next few weeks. He is a bit concerned about the uncertainty overall with the election outcome. So he sees a 5,300 to 5,700 kind of range over the next couple of months till maybe October. And then he sees a breakout from there towards closer to 66,000 to 6,100 by the end of the year. That was his prediction in the closing bell interview today. That said, he is thinking that maybe market is getting front loading these expectations of the uncertainty and the election outcome. It's possible that maybe we may not wait till after the election results to break out. Maybe the market may do that ahead of the results, and perhaps you might even get a breakout earlier than the early November when the election results are going to come out. That was his thoughts. On the flip side, if you look at Mike Wilson, the chief market strategist at Morgan Stanley, he was at risk reversal. This is a podcast that Guy Adami from Fast Money runs with Dan Nathan. And in today's interview, basically, it was not today, it was yesterday, Mike Wilson seemed to be quite bearish as he normally is. He felt that the August pullback was really market's way to warn that there is something bad in the economy. He doesn't know what would be the hair that breaks the camel's back, but he does feel that there are a lot of negative things on the ledger to be worried about, and he does feel that there's possibility of a slowdown. All these earnings expectations into next couple of years may not actually pan out, and he does feel that the labor market could start slowing down and potential recession to be quite possible in the horizon. So he seemed to be quite bearish. And Carter was on the same risk reversal show the day before, right when market was kind of selling off he showed this chart where he showed a double top. So S&P tested towards the July time frame of 56.69, then it came back up to 56.51 recently and then pulled back. He painted this as a double top, and he showed that, look, if you look at the long-term weekly chart, you can draw a trend line across the lows from October 2023 to the pullback we got in April to now. If you draw that trend line, S&P broke below the trend line and came from below to test the trend line, and then it failed. So this double top, to his point, if you're talking about a double top, it's usually an M shape. That means that you kind of start up the M from maybe from the April low around 49.50 or so, went up to 56.69, came down to 51.19. This was the August 5th low, came back up to 56. This could break below the August low was his point, and he would be looking for perhaps a retest of April low and potentially a break below it. That's Carter's view. That said, if you look at what happened in S&P, that morning, yes, S&P, this was when the CPI data came out, came to as low as test that 5,400 level. It was a slightly higher low than the 5402 that the market had last Friday. Remember, the market had a very bearish close the first week of September. It had only 4 trading days in September because of Labor Day. But each of the days it kept coming lower, and from a 5650 the previous week, last week it ended closer towards the 5,402, 55402 level. Solid climb this week, as we can see, every day it has climbed, except Wednesday, intraday in the morning, it had dipped to retest at 5,400. But this, if you could say, is a beautiful double bottom test. So it tested 5,402 last Friday. This Wednesday tested that again, and then buying came up, and it now is at a higher low. That's what Mike Wilson's point is. He's not celebrating yet. He feels that market is still giving some signals of lower highs. So he had a 56.69, 56.51, and today's high was 56.36. So these are a trend of lower highs that Mike Wilson is warning, and he feels that potentially we could be setting up to fail here and then come back low. That said, this has all the looks of a beautiful cup and handle, just like what we had here in the April to May timeframe. In the April to May timeframe, we see that from 52.64 we came to 49.53. We had a slightly higher high at 53.41, then formed a handle late May and then broke out. That breakout had a beautiful cup and handle breakout, and we tested new highs at 56.69. This time, the only difference is that time when that cup and handle happened, we had a higher high in the right side of the brim of the cup than on the left side. This was 52.64, it hit 53.41. RSI was also at a slightly higher high than the previous RSI, and so was the PPO level. This time, there is a bit of a red flag where we have come back and not yet put in a higher high from the July high of 56.69. We fell at a lower high at 56.51. Also, RSI is at lower highs, which is a negative divergence. We had a much stronger RSI in the July timeframe. In the August recovery that we came up to 56.51, we see at a lower RSI. So that's a negative divergence. Same thing with PPO. PPO was at a higher high than what we got towards third week of August. Since then, we've pulled back. But if this is at the end a cup and handle, just like we saw a cup and handle here in the April to May timeframe, that breakout from a 51.19 to a 56.51 could easily take us closer towards the 6,100, 6,200 level. That's something to be watched. Not sure what the outcome will be with the way FOMC signals a rate cut next week. If the market will like it or market get concerned that perhaps Fed is signaling concerns in the economy and maybe they're getting a bit too dovish, that may not be good. That market would perhaps sell off from it. But if market likes the way he signals his rate cut, signals his confidence in a soft landing, we could potentially see, as Tomlee is expecting, front-loading of the uncertainty, front-loading market's concerns about the recessionary fears, taking it out and breaking out higher. That's something we need to watch, something that a lot of market participants will be watching. In a similar way of a pattern of lower highs, we also see that in QQQ's chart. Just that QQQ's slope is a lot sharper than what we have here in the S&P. S&P, the highs came very close to each other, 56.69, 56.51, 56.36. They're very close within, like, talking about 16 to 17 points kind of difference between the highs. Here at QQQ, it's a much, the slope is much sharper. 503, 485, and today it kind of topped out at 476. So if this is also a declining trend of highs, lower highs, it's to be seen what would QQQ do. Would QQQ break out of that? If QQQ breaks out of that, then good chance we are likely going to go retest the July highs at 503 and continue higher. That's to be seen. But right now, it's at a trend where bears would say that, you know what, you got a pattern of lower highs and higher lows. Maybe this begins to form a pennant. Normally, pennants tend to break out in the direction of the main trend, which the main trend has been higher from 412 to 503. So, the bulls would say that this pennant would break out in an upward direction, versus bears could say that, look, they've had a negative divergence here. RSI is not getting strong, PP is not getting strong. We've seen signs of very sharp pullbacks in nvidia, semiconductor stocks, and technology stocks in general. Maybe we could sell off into the month of October, which historically is known as a very unpredictably bearish month. As we said, we're going to talk about the China, look at their core iShares MSCI China ETF. This is called MCHI. This is in many ways ascending triangle forming. The key in China is there is expected mortgage rate cuts. They last time did a cut in July. Right now, the rates, it's over 5 trillion of mortgage debt that the Chinese citizens and Chinese consumers own. It is significantly hitting them hard for their spending because of these high interest rates. Market is expecting anywhere from 50 to 80 basis point cuts in the next few weeks. Ideally, a cut coming next week is what market is thinking. There's some Chinese holidays coming up. But that said, if this ascending triangle pattern of higher lows, 33, 22, 35, 39, breaks to the upside, we're talking about a move up to 75. That's where MCHI could go. A key stock in the Chinese that we are following, especially something that is e-commerce giant like Alibaba, JD.com is an e-commerce giant. What's powerful about JD.com is over 70% of the market cap is in cash. We're talking about right now the stock price is at 26, about $17 to $18 of cash they own in their balance sheet. So this is a company that also has been doing reasonably well with their margins. In the recent earnings, they beat the expectations on profits and revenue. This could potentially be an inverse head and shoulder. Yes, it's got a slanted neckline, upward slanted neckline. The neckline kind of meets near 30, so it's got to break above 30. But if you do the measured breakout of this inverse head and shoulder, potentially it measures to 35, which is where it was in the May highs. We noticed that when the wealth managers in many parts of the world had gone bullish on China as a contrarian play the first part of the year, that was well founded. So January was many of them started getting bullish, and we saw a very nice run in JD from 20 to 35. It was not just JD. If you look at MCHI, it also had a beautiful run at the beginning of the year for somewhere near 35 to 47. So market did very well, the Chinese market, the first part of the year. Since May, we've got the last 4 months of pullback. Same thing with JD, no different. It's got pullback from the 35 to low of 24. Potentially, if the PBOC cuts the rates on the mortgage lending, potentially we could see this breakout, something to look at. And that could be a bullish contrarian trade, and potentially from 26 to 35, that's easily, you're talking about a 9-point move on a base of 26, closer to, talking about anywhere from 9 out of 26, you're talking about almost a 25% move. Not bad at all. In fact, 9 is more than 25. You're talking about a move of closer to, I would say, 30-35%. Finally, we're going to look at gold. We're going to look at GLD, which is the ETF for gold. This, as we know, has been a lot of perma bulls on gold, enjoying the nice rally that it had over the last several years. So this is the daily chart of GLD. It paints a nice ascending triangle pattern, testing the 225 a few times. The low was 210. So if you 210, 225 is 15 points. At the 15 to 225, you get 240. So that's the level. We had a nice gap up and nice move up in the last couple of days. So after the CPI and PPI data, it's closer to 239, got another point or so. Near term though, we feel that this dollar is pulled back a lot. Potentially as dollar gets a bid, perhaps after FOMC next week, gold could perhaps have a pullback. So near term, we feel that 240 could be a target that GLD meets ahead of FOMC. Helene Meisler has talked about the daily sentiment index on GLD getting closer towards the 85 level. Typically when DSI gets closer to the 85-90 level, it gets a bit too overbought or a bit too bullish on the sentiment, and then gets a pullback from there. So we wouldn't be surprised if GLD kind of meets this 240, 241 target and then has a pullback after FOMC next week. That said, if you look at the longer term view of GLD, this is a beautiful cup and handle. Yes, the left rim of the cup is 174, base of the cup at 100, right rim is $20 higher at 194. So 100 to 194 is 94 points. Add that to 194, you get 288. So 288 potentially is where GLD is headed. There's a much longer handle after a nice, a cup right here. So if you look at a nice a beautiful bowl-shaped cup with a nice long handle, that breakout at 288, we've already seen RSI strength holding above 75, 78. We see PPO is climbing above the center line. PPO had pulled back when the handle was forming, tested the center line, and then since has been climbing. That's bullish. We'd love to see AD accumulation distribution to climb even further to higher highs. So far, it's still at a lower high from the top of the brim of the cup right here, but it's climbing. It's on a climbing trend, which is positive. One thing to be looked at is we look at the relative performance of GLD. As much as the great move we've had this year, it really significantly underperforms S&P 500. Talking about minus 65% underperformance of GLD to S&P. So now you know why the god of investing, Warren Buffett, does not think much about gold. He doesn't invest much on gold. And you look at an underperformance of 65% of GLD to S&P, you know why he stays away from it. That said, there are people who are looking at gold miners as a proxy to play the bullish move in gold. That's GDX, that's the ETF of gold miners. The long-term chart here, the monthly chart. This has got a beautiful ascending triangle forming. From 43, pull back to 11, back at 43, series of higher lows, 11, 15, 20.82, 25, and now it's near 40. We expect this to break out above 43 and continue to climb towards, once this breakout happens, from 11 to 43, you're talking about 32 points. At 32.43, that's 75. So that's where we see the eventual upside for GDX, the gold miners. So from 40 to 75, you're talking about 35-point move out of 40. That's very close to 85, 90%. Solid upside is there in GDX. So if anyone who's looking to play, the only thing is in the climb, not as much volume. As a result, AD has been kind of flat. We would love to see AD start climbing, which means smart money, moving money into it. So far, yes, central banks across the world are buying gold, China in particular, and some of the others, to diversify out of their dollar holdings, buying gold. But we are not seeing as much of smarter monies, things such as hedge funds and others chasing gold to that extent as we would want, especially gold miners for sure. So that's something. PPO, however, has pulled back, has tested the center line, and now has begun to climb. So we'd love to see momentum pick up. That would be a very bullish sign. So we're talking about Newmont Mines, NEM, we're talking about Randgold, GOLD, we're talking about Ashanti. There's a bunch of strong gold miners that would have very strong upside once we see this breakout in GDX. But that's the key. For the real bulls, maybe instead of anticipating, see the breakout above 43 with some volume, and then you could be rest assured this bullish run continues towards the target near 75. With that, happy investing. Next week, we're expecting FOMC Chair Powell to announce his rate cut decision on Wednesday, and it's very interesting to see how the market reacts to it, and good luck with your investments. Thank you.